Hello, and welcome to Law Deals, where we talk about law firm succession planning, partnerships, purchases, and sales. I'm your host, Ed Alexander, and today I'm excited to be joined by my friend and someone I've called partner for almost 2 decades, Matt FitzGibbon. Matt is an ASA senior appraiser, Florida licensed real estate broker, and my co-shareholder at FitzGibbon Alexander, Inc., our business brokerage, valuation, and transactions consulting firm. Matt has 30 years experience managing private equity and owning and building businesses. He's participated in over $1 billion of real estate and business transactions as a broker, partner, or appraiser. He also served 10 years as a volunteer on a canine search and rescue team, handling a German Shepherd cadaver dog to assist law enforcement in recovery of missing people. Matt is a navigator who brings a wealth of experience in helping professional service firms and businesses understand their true market value and helps them traverse the complexities of ownership transitions. I'm really looking forward to unpacking his insights on valuation methodology, common pitfalls, and strategies for maximizing value during transitions. Today, we're going to dive into the unique challenges of valuing law firms and professional services businesses, particularly where those owners are also a primary component of the business and really carry significant goodwill with their clients. So without further delay, welcome, Matt.
It's great to see you, Ed. Thanks for initiating this. Always look forward to speaking with you and catching up, and especially on this topic. And I can't believe it's been 2 decades, though, over 2 decades. Are we really that old?
Yeah, it's shocking. All right. So, Matt, before we dive into technical aspects of valuation, let's share a bit about your professional journey, because I think you've got some interesting things there, especially with the private equity piece.
Well, the quick story is I started in private equity investment management back in '94, and was managing private equity and doing private equity investments in the middle market. And then when I moved to Orlando here over 25 years ago, I started trying to source add-on acquisitions for our platform companies, which got me from the private equity world into the Main Street world. And that's where I had a very abrupt realization that the private equity middle market is a very different world than the Main Street world. And then in the post-2006 depression, when the M&A world was dead, I decided I've been doing business val for 10 years. So I said, well, let's go after the credential. So I traveled around for a couple of years to get the accredited senior appraiser and BizVal designation with the American Society of Appraisers, so I could do court testimony, things for the SEC and the IRS, gift tax returns. And that's kind of how I got into the appraisal side. But at heart, I'm a transaction guy.
Cool. And just so everybody knows, if that thud or I don't know, low roar that you heard as Matt was talking, Matt's office is actually in Daytona. He and his wife own a condo up there on the water, and he's got an office up there. And it is the precursor to Bike Week, I think you said. So yes. We might do that over and over again as those bikes roll by.
I'm sorry about that, but yes, my office is right on Ridgewood Avenue in Daytona, and we are at a perfect place where the bikers can gain speed coming off a light. So Bike Week is the roar of the engines up here. And we just finished the Daytona 500 last week, so it's been a pretty active place.
Pretty active and busy place, that's for sure. All right, so tell the story of how we got together in FitzGibbon Alexander.
Well, that's a vivid memory. A couple called me up and asked me to represent them in the sale of their restaurant in downtown Orlando 20-some years ago, and I sent them over a listing agreement and said, sure, I'd love to. And a few days later, I got my listing agreement back, awash in red ink. It was from you. I did not know you at the time and that you were their attorney. And I called you up and I said, I don't really know where to start with this listing agreement here. You made a lot of changes. And you said, if I remember exactly right, you said, Matt, I just want it to be that if you sell the business, you get paid. And if you don't sell the business, you don't get paid. And I said, I'm good with that. And you went, oh, great. So we did the transaction. And it was a very difficult transaction, as you remember. Mm-hmm. Fortunately, the broker with the buyer, who was very difficult, was a really good guy, had integrity as well. So we got the deal done. We started referring transaction, worked back and forth. In the next 5 or 6 deals, we closed all of them and said, this defies all statistical probability. And that's what kind of led to the partnership. But as an aside, I forgot to tell you a couple weeks ago, I was out on a long walk and I ran into the husband walking his dog from that original transaction.
Wow.
He says hello, and they are doing very well. So there you go.
Good. That was interesting. I remember it was a full price cash offer, and I almost fell off my seat because I knew a lot about that business, and they had set the price, and I was like, okay, well, give it a try at that price. We'll see where we go. And then came in with a full price offer, and yes, that buyer was definitely a challenge. Let's put it nicely. It was a challenge. Okay, so let's switch over to law firms and professional services firms. So let's kind of talk about the unique issues that come up with valuing those firms and what makes them different from every other business that you've performed valuations for.
Well, law firms fall in that bucket of professional practice, like doctors, accountants. And because professional practices have a lot of personal goodwill, a lot of the valuation of the business has to learn how much personal goodwill is tied to the business. For those folks who are maybe not familiar with the difference between personal and enterprise goodwill, although you talk about it a lot in your podcast, you do a great job describing it. I just tell people it's the difference of if you have a doctor for 20 years and all of a sudden you go to see your doctor and a new guy comes flying through the door and says, hey, I'm Bill Jones, your new doctor, because I bought this practice. You might be a little nervous, like, well, wait a minute. Do you know my health history? Do you know my issues? There's a relationship there. Versus on my way to Daytona in the morning when I stop at my local McDonald's and I get a cup of coffee and a breakfast sandwich and the guy comes to the desk and goes, hey, I'm the new franchise owner of this location. What can I do for you? I'm like, I don't really care. I just want the coffee and the breakfast sandwich. Right. It really doesn't matter who owns the establishment because we go there for the value, the consistency, the reliability, the product or the service. So with a law firm and other professional practices, we got to look at the good personal goodwill involved.
So we talk a lot about this, as you mentioned, and kind of the issue is how do we transition that personal goodwill in the beginning over to the law firm, right? Through having a team approach and making sure that not one attorney is constantly communicating with the client and making sure that everybody on staff has a hand in communicating and providing work for the client and that the client understands that they're working with the firm, not with any one particular attorney. But as a seller, that could maybe offer an opportunity because then you can sell the law firm and then simultaneously sell the goodwill that you have as the law firm. And that might offer, depending on the law firm structure, might offer a tax opportunity there. So just something to keep in mind, and we can kind of talk through that. But when you look at these what I call primary producer businesses, right? How does that factor into the overall value? So you know that the lawyer has a component of goodwill, personal goodwill. And there's some measure of enterprise goodwill for the practice. How do you work that all together in your analysis?
Well, I think to answer that, we just have to take a step back to what is at the core of business valuation. And that is the very base of business valuation. The foundation is the future cash flows of the business and the risks of those cash flows. So the amount of personal goodwill in the business has to do with the risk of the future cash flows of the business. So that's what we're looking at when we look at personal goodwill, if that makes sense.
It absolutely makes sense. And so one of the things that we like to do is try to mitigate that risk by making sure that the owner, the seller, the person who's leaving, has an obligation to transfer that goodwill and, mitigate that through obviously an of counsel agreement, which is a fancy consulting agreement for lawyers, and making sure that the name can be transitioned. And we do that. There's a specific set of Florida bar rules and frankly, rules in every jurisdiction that deal with how we make that transition. So if we start doing things like that, what's the impact then on that risk factor?
Well, if we build a system where we have very little personal goodwill and more enterprise goodwill, then we have less risk to the future cash flows of the business. So the value of the law firm is likely to be higher.
So now, let's walk through kind of your approach to valuing a law firm or other professional services firm. So what kind of are the steps that you go through, and then the methodologies you use?
Well, I'm happy to. You tell me how much detail you want to get into. Where I start, of course, is every business valuation has two components. There's a quantitative component and a qualitative component. So I got to do the quantitative analysis and a qualitative analysis. I start with requesting from the business owner a lot of financial documents, 3 to 5 years of their financial documents, as well as contracts, agreements, things about their employees, et cetera, et cetera, et cetera. And then I also have like a 14-page questionnaire I sent them that asks them lots of questions about their business. So I then look at the quantitative side, which is I look at their financial documents, and I recast them, which means I basically look at their net and I normalize and adjust and let me know if you want to get into that side of it, their financial documents to see not only what their historical cash flows were, but also and primarily what we're looking at is what we anticipate the future cash flows to be. And then on the qualitative side, I'm looking at all of the things that aren't number related, but things that are more risk related to those cash flows. So that's going to be a lot of questions about how long you've been in business and what your turnover has been, and if there's other family members in the business that are going to be leaving with you when you sell the business, things like that. We're going to look at all of that. But we start with trying to do an analysis of both the quantitative side and the qualitative side.
That's interesting. There you go. Got one.
So there'll be a couple more before you're done, probably.
I'm sure of that. So the question I often hear people ask is, what's the multiple? They always want to know, what's the multiple? So let's talk about the multiple, right? So you've determined your cash flow, you've determined your risk factor, or maybe your adjustment for the risk factor. What's the multiple? Tell me about the multiple.
So my answer to that question is multiple of what? Because at the end of the day, we got to know what we're putting a multiple on. You know, are we talking about EBITDA? Are we talking about ordinary income? Are we talking about net income? Are we talking about free cash flow? Or what are we talking about when we say we're going to put a multiple on something? What measure of cash flow? Number one, and number two, has it been adjusted and normalized? In other words, if we have, let's say we're just showing, let's say we're showing a cash flow of, let's just say $250,000 of cash flow. Okay, but the owner also has an airplane that he services for $30,000 a year. Okay, well, the buyer probably is not going to have that airplane, so we need to drop that $30,000 of expense down to the profit and increase the profit. That's what I mean by normalize whatever measure we're going to put a multiple on. So 2 questions about the multiple. Number one, what metric are we going to put a multiple against? What measure of cash flow? And number 2, has that measure been normalized and adjusted yet or not?
Yeah, so let's talk about the normalization real quick before we go back to the multiple there. So you mentioned, these kind of extraordinary expenses, but they go both ways, right? So if a lawyer has a spouse that is working in the business and we're not paying the spouse, right?
Yes.
Or maybe we're paying them under market value, you've got to adjust that up. And something I encounter all the time is that lawyers own their building, and instead of paying a fair market rent, they pay a very low rental rate, right? So we've got to adjust that, because unless that owner is willing to keep leasing it at a below fair market value rate, then obviously there's an adjustment that has to be made there. Those are 2 common ones that come in. And then everybody deducts, I say everybody, almost everybody deducts the owner automobile, they deduct the travel, right? They deduct, maybe they go to a game, something along those lines. But at the end of the day, we're normalizing all that out, so we show what the true cash flow potential of the business is.
Yes.
Okay. So now let's go back to the multiple. Okay. So where does the multiple come from? We're going to use a multiple of EBITDA, because That's what everybody wants to know. EBITDA,
Okay.
right? Earnings before interest, taxes, depreciation, amortizations, right? But it's not actually EBITDA; it's adjusted EBITDA because we've
Correct.
done that normalization, right? So where do we get that? Where do we get that multiplier from?
We get it from the market. We look to the market. We look at other transactions that have taken place, and we look at what those transactions have sold for.
And so we go to the market. How do I find out what those are?
Well, if we're talking about a market approach and we're comparing a particular industry, in this case, we're talking about law firms, we're going to look at transaction data from a number of sold law firms in the same, let's just say in the same revenue range. And we're going to compare what they sold to and the multiple of cash flow that they sold for. And then we're going to get to the same adjusted cash flow and apply that multiple to the subject company.
Okay. So I guess what I'm getting from this is I have to pull this information data from someplace. So you've got to have a database that you go to for you to use for this, right? And so ultimately you got to subscribe to a database to get these multiples. The other takeaway here is there's not one multiple. The multiple depends on the characteristics of your practice, right? And so ultimately, I think if I were to look at it, some measure of risk is based into these multiples because they're industry-based and they're revenue-based and they're size-based. So when somebody comes to you and says, I've got a law firm that grosses $1 million a year, what's my multiple? You can't answer that question because you don't know enough information to answer that question. Is that a fair statement?
Absolutely, especially multiples as a percentage of sales. And anything that you're looking at is a percentage of sales. A benchmark, a rule of thumb is what I call that. You know, people say to me, this restaurant type is selling for X percent of sales. Well, there are a couple industries out there. Several industries out there that type of business is so similar, regardless of what size it is, that you can get reasonably close if you use a percent of sales method. But that is, I would say, not typical and certainly not anything that I would rely on.
Good. All right. So now we have client retention risk in there. So how are you looking at client retention risk, and what strategies would you suggest that a law firm use to mitigate this risk when they're going to sell the law firm or an owner is going to transition out through a succession arrangement?
Well, I think a lot of the things are the obvious ones. Having the seller stay on for a particular period of time to give confidence to all as they disclose the sale has taken place, and to introduce the buyer to all the clients, giving all the clients confidence that the relationship they had with their original attorney is still going to be intact for a period of time, and giving them time to get comfortable with the buyer. There's obviously handling that is very important. I think that I would throw one thing on this, that is, although it's a risk, I got to tell you honestly, after doing this for decades, it's very rare that I've ever seen a business transact and all of the clients or customers flee. I'm struggling sitting here today thinking of a business that happened to, because sellers and buyers, all of us business owners, we all have an ego, and we all tend to overinflate our importance to our customers and our employees.
Never.
I know it's hard for you to believe. I know this is very, this is a hard teaching here, I guess, but we really do. And it's sad, but I've every seller who said to me, "Oh, as soon as my employees find out, they're going to go get a job somewhere else." No, they're not. Not as long as the buyer is going to pay them. Oh, my customers are all going to leave. No, they're not. Not as long as the buyer and the rest of your staff continues to meet their needs and provide their services. The last thing they want to do is go somewhere else and have the hassle of trying to start over in a new relationship.
Right. Switching costs. Yeah, exactly.
So as long as the buyer comes in and treats the customers with respect and humility and really treats them with customary practices, good customer service, it's very rare that I worry about the risk of customers leaving, clients leaving, or even employees leaving.
Yeah. So it's interesting because in a lot of deals that we do, we get approached by a buyer, and the buyer is wanting to do a complete earnout on the deal. So this just happened recently where, we had, it was an estate planning law firm, and really wonderful law firm. I mean, it's been in business for decades, right? So we're not talking a short period of time, decades, and literally thousands of wills in the will vault, right? So long-term relationships where, the adult children of the original clients are now coming back, right? And the buyer or prospective buyer, because it didn't happen, came across with an offer that was, well, I'll give you X thousand down, which was, five figures, low five figures, and then I'll pay you a percentage of whatever comes in. Well, now you've put all of the risk on the seller. The buyer has no risk whatsoever, right? They're taking a flyer. They're getting team members. They're getting infrastructure, right? And now all of a sudden we put it on to the seller, all the risk onto the seller. And when you reply to a buyer or prospective buyer and you say, well, exactly what is it that we're doing here? Like, I'm basically allowing you to take over the practice with no skin in the game whatsoever. And you're putting all the risk on me for this coming out. Why would anybody do that deal, right? Why would anybody do that deal? And then the response that we get back is, well, what if all the clients leave, right? So I appreciate you saying that because I've never seen the clients leave either, right?
It doesn't happen.
Yeah, you might lose a couple, right? You might lose a couple. Maybe they were unhappy in the beginning, but the transition has to be managed. And as long as that transition is managed properly, then it should not be a problem, right? So,
in fact, sometimes it's the exact opposite, Ed. I had a printing company once where I sold the printing company, and the seller the whole time was, oh, my employees, they're all going to leave. My employees, I don't know that they'll stay. Well, they can't find out. And all this went on for months. We finally sold the printing company. And I ended up in a long-term relationship with the buyer of the printing company, adding printing companies and doing more. And so I got to know some of the employees that stayed with the business. And so when I would visit, I would say, so how are things going? How do you like the buyer? And how do you like it? And the employees were like, this buyer is awesome. They are so fantastic. I can't believe I was ready to quit until he sold it and this buyer bought it. This is awesome. This has been so great. We're having the best time here. You just go, okay. There you go. It goes both ways.
It does go both ways. That's for sure. All right. So, a lot of law firm owners that are working on their succession plan will go to an online law firm calculator, an online business value calculator. So tell me, what are the pros and cons of those?
Oh, I think they're awesome. They're fantastic.
And
I'm sorry, just messing with you, Ed. There are all cons and no pros. And here's why. I mean, the pro would be if you want something quick and fast, you can do this. But in that, the con is you're not going to get something that's accurate, in my opinion. And here's why. No matter what you put in the inputs, they're not going to be adjusted. So again, it goes all the way back to whatever inputs you put into that calculator, you have to adjust your cash flow first before you put any inputs into the calculator. Second of all, the calculator is built to give you an average. So if you're a below average company in an industry, then you're going to think you're worth a whole lot more than you otherwise are when you go to the market, and vice versa. If you're way above average, then obviously you're going to be leaving a lot of money on the table. I did a presentation years ago where I actually used an online private equity calculator that a private equity firm put out there for sellers. And of course, it kicks back a rule of thumb of 3 to 5 times EBITDA price for no matter what you put in there. But, I then put another slide up and I said, here are the last, I can't remember, it was 5 or 10 transactions that one of our private equity groups did. And even though the calculator was spitting out 3 to 5 times EBITDA, we had 6, 8, 12, 13, and sometimes higher EBITDA multiples because of the companies that we were buying, building, and transacting. So there's a potential to leave a tremendous amount of money on the table when you use an online calculator.
Or to make the opposite mistake of pricing it too high and then just sitting on it as people look at it and realize there's just too much risk here to go. I think the online calculator is, the value in it is that you kind of have an idea in general about where you might possibly be and end up, but you cannot rely on it. You can't rely on it for your planning purposes. You can't rely on it for going to the market, certainly, and trying to sell, and also for selling internally, right? We have to have other factors involved, and that's the qualitative piece that usually isn't in there, right? So it's kind of this, what is the average firm worth? So there's some danger in those. So if you're looking to do the succession planning in 3 to 5 years and you want to maximize the value, what are the steps?
So in order to prepare for a 3 to 5 year exit?
Yeah, what valuation considerations should an owner be thinking about if they're looking to exit in 3 to 5 years?
I would put kind of at the top of my list in the top order. One is increasing sales and profitability is always good. Nobody wants to buy a business that is starting to trail off in its sales and profitability because, of course, every buyer is wondering how far is it going to go? Where's the basement on this? Obviously, flat sales works for people. But what people really want to see is they want to see an increase in sales and profitability. They want to see a business that's growing and is healthy. So this is oftentimes challenging with the person who calls you up and says, I want to exit my business now. And yet they've been hanging on. So the advantage of the 3 to 5 year plan is you're still engaged in the business, you're still working the business, you're still marketing, you're still bringing on new clients, and any buyer is going to see growth and see the energy there to continue on. So sales and profitability increasing, I would put as number one. Obviously, anything that increases the discretionary cash flow to the owner, your seller discretionary earnings or your owner benefit, 2 definitions for the same thing. Increasing that cash flow, which is going to be capitalized, you're going to want to look to do that. Obviously, focusing on anything that's systems dependent and makes the business more turnkey so that you're not tied to the personality or the relationship to the seller. Anything that makes the business less dependent on that relationship is good. CapEx adjustments. You don't want to go to a buyer who walks through and says, well, all of your computers are, vintage, 2007. But they still work for us. Yeah, well, then the buyer has to add that to their price and. So I think all of those things, looking at customer concentration, adjusting your lease, all of those things I think are important if you have that time horizon, which is great to have.
So if I had to sum it all up, I'd say run it like you're going to continue to own it beyond the 3 to 5 years. Is really what you're talking about, right? And not run it in the sense of I'll get by with this lousy furniture or the ripped carpet in the entryway or the 2007 computers. It's run it like a real business, and that's really the key there.
Yes, and it does pay to get back to your carpet comment to make the place look nice. It helps. People don't buy businesses off emotions. People will overpay for a house. I think 20 some years ago when I bought my house, I overpaid for it to some degree. But that was okay because my wife loved it and we expected to raise our kids there. People don't do that with a business. They ultimately will get down to, when they write that check, what is the return I'm getting on my equity, my investment, the salary I'll be paying myself, et cetera, et cetera, et cetera. It will come down to the numbers at the end. But they want to be able to envision themselves working in that space. So making the space pleasing and comfortable and attractive does pay off in bringing a buyer who will say, okay, I can imagine myself working here. This is good. So I'm not going to say that affects the ultimate price someone's going to pay, but I will say that it will certainly help move things along when somebody feels like this is an attractive place to work and come to each day.
So I'm going to disagree with you a little bit there. I think everybody and his brother, whether it's a business decision or a personal decision, makes their decision emotionally and then justifies it with the numbers, right? So we get to the same place, Matt, and that is, when I walk into this place, I can't be repelled by it. I got to look and say, wow, this is a nice place. I could see myself here, just like you said. Because at that point, then they're looking for a reason to make it work. If you come into a place and the carpet is ripped and it's dingy and dark, right? Yeah, they're going to look at that and go, I don't know about this. And that's the worst possible thing you can have happen, because buying a business, as we know, is a long haul, right? And so if you walk into this and saying, I'm not sure in the beginning, it's never going to make it to the end, right?
Right.
So good. All right. So make the place look good, make it a real business, and run it. Perfect. It's exactly what we talk about on this podcast all the time. Okay. So if you had to pick one or two things that are the most important for a law firm owner to do in getting ready for succession, right? What would you say? Obviously, I want to drive up value, right? So this is my key. I'm gonna exit. I want the highest value for what I can get here. What are the one or two things that I focus on that, boom, that's going to add value to the law firm on an ongoing basis?
Well, I think the value drivers we just discussed, all of those, getting back to the increasing sales and profitability and increasing your cash flows. But again, jumping to the 20,000-foot view, anything that's going to increase your cash flow and reduce your risk to those cash flows is a good thing to be doing if you have time to get that plan before your exit.
Yeah. So the number one driver is what is the actual financial metrics of the firm, right? Mm-hmm. And so of those, it's really the two pieces of what are we bringing in the top, and then you say increase in profitability. I think you're talking about increase in profitability not as a percentage of revenue, but as the overall raw number of profitability, right? So that we maintain that percentage at a minimum. We maintain that percentage as revenue increases, right? So if in the SDE, so seller's discretionary earnings, if we're throwing 35% to the bottom line, we don't want to increase from 1 to 1.2 million and make it go down to 25%, because that isn't going to work at all, right? So we've got to make that increase correspond with the way that we've been doing things and continue to work the business that way and not really drive overhead. Example that some people give is like, oh, well, I can go from 1 to 1.2. All I have to do is spend $200,000 on, Google ads and I'll be fine. Well, that isn't going to work. That doesn't do you any good, because it's not going to bring you any additional profitability. In fact, it's going to reduce your profitability.
Yes.
All right. We've worked together on numerous transactions over the years. Could you share an example of a particularly challenging situation and how we navigated it?
How long is this podcast? I can think of a number of them. I think one we did not too long ago involved a broker who wouldn't allow me to present an offer to the seller in person, and a client who was emotionally freaking out about the deal, even though he was very, very, very successful in his core business. So, in fact, I asked 3 times to present the offer to the buyer, and they didn't want to let me do that. And when they finally did, we kept persevering and finally did meet with the buyer and move through that situation there. And the seller was emotionally uptight about the risks for the acquisition.
The buyer, I think you meant.
Yeah, the buyer. I'm sorry. I apologize. Yes, the buyer was very upset about the risks to the transaction. How oftentimes buyers come to transactions looking for the strength of the business to give them confidence in the future of the business, instead of thinking of their own experience and their success and what they're bringing to the business.
Yeah.
and I think not to digress, but I did have a good example a couple of years ago. We had this multi-million-dollar business and a lot of private equity interest, and got a letter of intent almost immediately. And it was a full price offer, and the seller was elated. Then we got the due diligence list a week later, and the buyers wanted to fly back into town. They wanted to do a ride along with the employees of the business. They wanted to meet a lot of the customers, and they wanted to spend a week or two in the business right there with all of the employees. That, of course, is not part of due diligence.
Right.
And so we ended up having a very difficult conversation, but what came out of it was these guys were new to the industry, and they were new to operations. They were mostly financial guys. And so they wanted to get embedded into the business to give them confidence in their ability to run this business. That is not what due diligence is all about. Due diligence is a verification. Due diligence is not a training ground to see if you can get to a confidence level and a comfortability with the transaction.
Put another way, it's not the buyer's job to make sure that you're technically capable to perform in that business. That's your job.
It's not the seller's job to make
sure. The seller's job. Yes, that is correct. Yes,
that's exactly right. You articulate these things better than I do. But getting back to the transaction, we had to constantly push the buyer back, turn him around and say, look at this incredible business you have built. All you're doing is adding on, doing the same thing you've been doing for several decades here. And see, your confidence needs to come from your own leadership and your own experience in the industry, not looking to the seller to give you the confidence to run their business. There's a fear element there that's emotional with buyers, where I have seen them tear apart good businesses that have been providing a great living for the owner and all of their employees and associates and team members, and they tear it to pieces trying to discern, really to get comfortable with them getting into the business, where that is not the seller's job to make them comfortable.
It's really interesting. And I'm going to analogize this because I had a conversation with a financial advisor the other day, right? And they were lamenting to me about a client who, they had run a Monte Carlo simulation, and I don't know, it came up in the mid 90s or something like that. And the client was like, well, I'm going to have to continue working. No, because 100% means there's something wrong as much as it means there's something wrong when it's 20%, right? I mean, at the end of the day, you're looking for, in the due diligence in particular, is what the seller telling me, is that accurate? And looking behind the documents that you receive to see, what can I ascertain? What can I verify of that? You're not looking for perfection. No business, no law firm is perfect, right? There are risks all around. But if you're a business owner or you're an entrepreneur, you've navigated those risks already. And you're going to apply your capability to those risks. But you cannot eliminate the risk, because if you eliminate the risk, the deal will die. That's just as simple as that. And that goes back to the example I gave before about the estate planning firm. They eliminated all risk for the buyer, and they dumped it onto the seller, and the seller said, no, thank you. I'm not willing to do that. So they killed the deal. You cannot have zero risk. It's impossible. If you're in business, I don't think in life, honestly, but maybe somebody will debate me on that. But certainly in business, there can't be zero risk, because there will be zero profit, right? That's the way it works.
And that's a great point, because if a buyer can't get comfortable with risk, and of course, manageable risk, then they shouldn't be buying a business. So whenever we work with buyers, we got to determine, do you have a risk profile and a risk tolerance to do a business transaction?
Right.
Because you cannot eliminate all risk from the transaction. Now, the buyer who says to me, well, there's a risk here and a risk here and a risk here, we've got this risk and that risk. Okay, well, let's talk about how we mitigate those risks. But we can't eliminate 100% of it.
Yes, it's all about risk mitigation, right? Not risk elimination. And we can't basically say we don't worry about that. We say, okay, look, there's a risk that clients will leave. How will we deal with that? Okay, well, if this, first off, we'll try and do what we can to make sure they don't leave by communicating with them, by making sure they feel comfortable, by doing the hand holding, the things that need to do. But if they do leave, okay, well, then we need to go and continue to market to the rest of the client base. Look to your history, what you've done in the past as a buyer, and where are the times when things have gone in a manner that you didn't plan, right? Negatively, typically. And what did you do to overcome those? You can have a plan to overcome them. You can do that. But again, they're there. And if you're going to be buying a business or a law firm or whatever you're buying, there's risk associated with it. And there's just no way to eliminate that risk. Good conversation on that. I think I wanted to go back to the point that we were talking about with the broker who wouldn't let you present the offer to his seller client. That was a unique situation. Well, I don't know, maybe not unique, but it was an interesting situation. What do you think was driving the broker to not want you to communicate and present the offer to his client?
Because in his experience, he said that every time somebody has done that, it has typically been a very, very low offer, and the buyer broker was coming in to try and sell and convince the seller that it was a good offer, and it ended up being a waste of everybody's time. So he said, if that's what you want to do, is come over here and try and convince my clients to accept this, what we expect to be a very low offer, then we don't have time for that. Because my clients live 15 minutes away from my office, and that'll take them away. And you're just going, oh my goodness.
So basically, he was concerned that you're going to try and bully his clients into it. But
yes.
It brings up this thing, right? Because to me, there are two types of negotiators in the world. There are horse traders, and then there are logical negotiators, right? And it's the horse traders are always, I'm going to get a deal. I'm just going to make an offer, and has nothing to do with the market, has nothing to do with, reality about what a particular asset is worth, right? It's just about, quote unquote, getting the best deal possible, right? And then there are logical kind of negotiators who will say, okay, your law firm is worth X to me, and here is why it's worth X. And then by laying out the parameters that got you to the value, instead of negotiating the value, you're negotiating over my points that I put in there. Why do I see these things that led me to the value, right? So the factors that lead me to the value, now we can talk about those factors, and we can talk about how I see them versus how you see them. And we're not really horse trading and getting emotional and doing all those things. We're moving into a more logical discussion that isn't personality based. So very important point that you raised there. And that is, let's get everybody together and let's have that conversation around objective criteria, not around feelings, not around, I want to get this for this price, that type of thing. So very good. Let's move on to the seller. So the seller had an emotional response to the whole transaction. So maybe, obviously, I don't want any, no confidential information, but let's dig into that a little bit further. What drove that emotional response?
Well, in this particular case, I don't think it was different than what we experience with a lot of buyers. It translates into fear of failure. Because when you run your own business and you've been successful, then you feel pretty confident in your ability. But then you see this other transaction come up here, and you're thinking about purchasing this new book of business. And then all of a sudden this fear comes in because you can't control it at this point. It is completely and totally out of your control. And what if goes through everybody's mind? What if there's skeletons in the closet? And what if there's, something, that they did wrong, and there's a lawsuit the next day, and there's this and there's this. And they come up with all of these fear of failure scenarios, and they can get overwhelmed by them if they don't think through them in a logical way. Part of it, I hate to say it, but it relates back to our ego too. I don't want to fail. I mean, we've been successful with all of this, and I can control all of this, but I have no control over what I'm thinking about buying, and what if I fail? And when at the end of the day, in a lot of these cases, if it's a very large middle market company buying a very small add-on acquisition, hey, some of them do fail. Statistically, they do, but it's not the end of the world unless your ego is wrapped up in that. So it depends on if you're an emotional person, if you're an objective person, how well you can manage your own emotions. There's a lot of elements in there. It's actually some pretty deep water.
It is deep water, but it's important to know that there is an incredible value for attorneys now to be able to go and buy practices, right? Because
Yes.
the money that you pay for the cash flow and the kind of return on investment that you get out of buying a law firm is significant, right? In fact, so much so that when I meet with lawyers who own their practices and looking to sell, I want to make sure that they're selling because of retirement or they were selling to go on to something different. Because at the end of the day, this is not a way to get rich. You're not going to get 10 times EBITDA or 8 times EBITDA in your law firm. It just doesn't exist, right? And so from a buyer perspective, I can come in and I can leverage those assets, especially where a seller is not a true business person, but they're more technician than they are business person. And if I, as a buyer, have those business skills and can apply them to a practice that I'm acquiring or adding on to my practice, I can typically generate a lot more net profit out of the seller's revenue than otherwise, right? And so there's this kind of opportunity that when we look at the risk of the downside, we don't also look at the risk of loss of that opportunity. What could I make this into? And so life is full of these two variable equations, and people always look at the one variable, but they forget about the other variable, cost of ownership versus what's the price, those types of things that ultimately, if you look at both pieces of them, you get a much more rounded approach to both doing law firm deals and otherwise. So interesting conversation. Yeah. Buyer fear is huge, and
Yes.
it's got to be dealt with at the outset. So let's kind of talk ways that we deal with buyer fear. And I'm gonna throw one out there first, and that is have excellent financial records.
Yes.
Do you have any you can think of?
Yeah, I think in addition to that, making sure that everything is prepared. If you know of anything that's an issue, disclose everything at the onset. If the roof leaks, tell everybody from day one the roof leaks. Anything that people find out in the course of a transaction that wasn't disclosed at the beginning, however minor it might seem to you, could end up being a really big deal to the buyer. This is why we do all the work up front, all of the analysis. We dig into a tremendous amount of data. We ask a ton of questions. We put hours and hours and hours and hours into the preparation of an offering package, because what we don't want to have happen is a buyer comes, likes the initial package, has an introductory meeting with the seller, says, hey, I like your firm. This all looks good. And then in due diligence, a couple things come up. Oh, by the way, we did have one really big case or one really big client deal, or one of our biggest clients did notify us they're leaving. We've had that happen in the middle of a transaction before.
Yeah.
I mean, the horror stories are great. As soon as you say something like that, even if you follow it up with, but it won't be that big of a deal because we have another one who's going to take their place, blah, 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 blah. The buyer hears, wait a minute, stop. You're now telling me something that gives me pause. What else aren't you telling me?
Right.
And that's what sets off the emotional fear. And they take a step back from the transaction, and then they start to really nitpick every other detail, and it slows down everything. Having said all that, getting back to the point is, if you are well prepared, everything is packaged properly, everything is together, and everything is disclosed at the beginning, and all they do is verify, then you're on your path to a very smooth and successful transaction.
Okay, perfect. Okay, Matt, real quick, let's talk about the different types of appraisals of businesses and how and what they should be used for, because this comes up all the time in our work with businesses and law firms.
So there's several types. You've got obviously a business appraisal. Obviously, the terms are thrown around, but a business appraisal has to comply with the Uniform Standards of Professional Appraisal Practice, or USPAP. That means it has to be very long. You have to, even if you're a small business, in order to comply with the USPAP standards, you have to analyze public companies, you have to analyze the industry, the national economy, regional economy, local economy. Even if you're a very small business, most of the business appraisals I've done that are comply with USPAP are somewhere between 80 and 125 or 150 pages. You don't need that unless you're going to the IRS, the SEC, or you're in litigation. Then there's a restricted appraisal report. Still has to meet all those standards. A little bit less of a report standard. But then you come down to what we call a broker opinion of value, or it's also called in the appraisal world a calculation. Calculation is a much faster, not necessarily less credible, but it doesn't have to comply with all the USPAP standards. Most of business appraisers don't like to do those, though, because it leaves you open to too much liability, depending on the purpose. So we also have a broker opinion of value, which is done by a business broker, or it could be a Florida licensed real estate broker, although the Florida licensed real estate brokers are supposed to also comply with USPAP technically. But a business broker opinion of value doesn't comply to USPAP, but it's to be used in the pricing of a business. And that we call a pricing opinion. And that's something that can be done off the quantitative and the qualitative information that we've talked about before. Does that answer your question?
Perfect. Excellent. Thank you. Yes. So in terms of using those, if you're relying on it for, the IRS approval or something like that, clearly you've got to go to a full appraisal that's USPAP compliant. Yeah. In terms of going out and doing a third-party transaction that's not IRS reliant, you can certainly do a pricing opinion there. So, yes. And that's kind of the ends of the spectrum of where we end up most. We either end up with within a full appraisal or a pricing opinion in what we're doing. So good. Excellent. Matt, thank you so much for being on the podcast. I appreciate it. Great conversation. If anybody wants to get in touch with you, what's the best way?
The best way is either to call at the office. I'm happy to take a phone call, or at email at matt@FitzGibbonAlexander.com.
And the office number
is 407-351-3909.
Perfect. Thanks again, Matt.